to everyone, our learners. A lot of you are seem to be regular over here, so it's good to have you back. And to anybody who's joined for the first time, welcome to Get Set Up. So today we have an interesting topic to discuss, and we're having this hosting this webinar. We'll do about 30 to 40 minutes of Q&A with our speaker, a conversation that I, your host, Ashwini Kapila from Get Set Up will be doing. And we'll open up for questions post that. In the meantime, should you all have any questions, just put it on the chat. So we are good to go. So how are we going to break this up today? We're going to have an interesting conversation on a topic of how to navigate retirement planning in volatile times, volatile markets effectively. And what are we going to learn out of this is we're going to learn how to navigate the complexities of retirement planning, which all of us are very keen to learn, amidst market volatility with an exploration of financial assessment and inflation considerations, one of the biggest eaters of one of consumers of our savings, and strategic investment approaches. We'll also be evaluating our financial needs, and we'll be understanding how inflation impacts it, optimizing the investment basket, and determining the optimum allocation across various fund categories. Today's topic is brought to you by Franklin Templeton. In a bit about them, but let me kick this off by letting all the people over here know what Get Set Up is. So Get Set Up is an organization which is on a mission to help those over the age of 55 learn new skills, connect with their peers, and unlock new life experiences. Our goal at Get Set Up is to reduce isolation, loneliness, and equip the community with the tools and knowledge to age independently in place. Our community engages in classes online as well as through offline activities like traveling together over longer and short day trips. So if you're not already part of Get Set Up, urge you to join the largest community of senior citizens, older adults, active agers, whatever we call ourselves over here. Today's class has been brought to you by Franklin Templeton, our sponsors. Thank you very much, Franklin Templeton. It is one of the largest asset managers globally with over 75 years of experience. And currently, the fund house is managing assets to the tune of 1.4 trillion US dollars globally. It has been a part of the Indian mutual fund industry for over 27 years and currently manages assets in India of up to 75,000 crores. Franklin Templeton India offers diversified bouquet of products spanning equity, debt, hybrid, and international funds, which can help to meet various financial goals of the investors. They have a rich history of being pioneers in many ways, like introducing the concept of SIPs in the Indian mutual fund industry. Their global parentage and local market expertise positions them uniquely in delivering value to our investors. And this topic is being presented to us, and in conversation with us is Mr. Sridharan, an eminent financial planner himself, a founder of a financial planning firm based out of Chennai called Volatile. He himself is a recipient of Associate Financial Planner title for retirement planning and employee benefits by the Financial Planning Standard Board. He's an active contributor to personal finance magazines like moneycontrol.com, Financial Express, Times of India, UTI Swatantra, and other such dailies and magazines. He's worked with Funds India, Quantum, and Allegro Capital before he set up his own business. He's been an independent financial advisor for over 15 years and has conducted regular sessions on retirement planning across many PSU banks, including some of the large ones like Indian Bank, Canara Bank, Indian Overseas Bank, and Bank of India. Welcome, Mr. Sridharan. Good to have you over here.
Yeah, thank you. Thank you for your good note, Ashwin. So we can.
We'll kick
Good
this
evening,
off.
everyone.
Yeah, thank you. We'll kick this off by just highlighting a few things that we're going to take away from you, Mr. Sridharan, with your experience and your astute planning that you've been conducting both courses online, offline for a lot of retirees, is to understand getting a financial clarity, which is effectively conducting an assessment of understanding our retirement needs and financial standing. So to kick it off, maybe you could just help us understand that what does financial assessment mean if we were to kind of break this into what do we need and what do we have, especially at this stage of life when we're dealing with our own retirement, getting a corpus from our retirement funds, whether it's a provident fund or other investments or the gratuity added to it, or even inheritance in many cases. How do we land up ensuring that we safeguard its safety, because peak earning capacity is kind of plateaued over here, as well as get enough returns to encounter both inflation as well as to deal with our own health issues as we age. And most importantly, while we plan that, you can highlight stuff about to ensure a good lifestyle, which we maintain during our work life. How do we ensure that we manage that with astute investment advice? So over to you, Mr. Sridharan, to get some wisdom from you.
Yeah, thank you, Ashwin, for your introduction. See, when we are talking about investments, that too at the age of, when you are at the fag end of, or maybe, after retirement, there are two perspectives. One is actually, we always think about making money. That itself is difficult. And secondly, at this age of 60 plus, they have money and suddenly they have created a lot of wealth basically due to their retirement corpus or inherited corpus or whatever it might be. They may be wondering what to do with the money first, and secondly, after retirement, one thing which is not going to stop is the expenses. The expenses is going to keep continuing, and the expenses are going to increase even after retirement. So the life expectancy on the other side, that also keeps increasing. Now 80 or 85, even people are living up to 90 or even century nowadays. So because of the improvement that has happened in the medical sciences. So when we are talking about managing money post retirement, that's a crucial part where one has to put in forth a lot of efforts and a lot of understandings, and also they need to put the money in the right way to ensure that that grows well. So it has to sustain its basically the people's lifespan, whatever the lifespan that we are talking about. So when we are talking about that, the first thing that they need to do is, first and foremost, they need to have a piece of paper first. And they need to understand what is exactly. So, what is the need that they have? See, basically, the needs might be visible. For some of them, the needs might not be visible. I'll give you a simple example. People at the age of 60 or 65, they may not think about the 80s when they need a personal assistant for them to manage themselves. There is a cost involved that they are not aware of. So after 80, they need a caretaker who should probably look after ourselves. We may not be able to look after ourselves after 80 or 90 or whatever the age might be. So it all depends on the individual, the health and other factors. So they need to factor in all these things. See, basically, one side, they need to understand what are all their needs. So the needs might be immediate needs, might be their food, clothing, and then maybe their medical expenses, or some might be a rigorous traveler. They got completely occupied with their own profession, where they were not able to do what they wanted to do in their life. So now the entire time is theirs, and they can probably, plan their retirement in a well enjoyable way, how they want to live. So the entire time is left with them. So these are the things, maybe, the basic requirements is one thing that they need to list out. On the other side, the luxury requirements, that also they need to list down. And thirdly, the unexpected expenses that may probably crop in at a later point in time. So this is something that they need to list down. So once they list down this, on the other side, what do they have? See, some of the retirees might be having some pension, some of them might not have pension. So what is that actually they are going to get? Whether they are going to get the pension income or rental income or something that they may be, people who joined after 2004 to the government office, they may not be getting, even pension also. So they might be getting whatever the corpus that is being accumulated in the NPS. So they will be getting some annuity. It is not called pension. Annuity is different. So the annuity is something, that they may be getting. How much annuity they are going to get? So they have to list down what is that they are going to have. So what is the need and what is the money that they already have that is going to get on a regular income that they are going to get it. So the requirement versus the need. If there is a gap, how they are going to meet out the gap is something that they need to plan. So the financial need is basically the financial need analysis. Is basically, what do they need on one side, what do they have on the other side, how they are going to bridge the gap. So the bridging the gap, they need to probably, whatever the corpus that they have accumulated. So that they need to invest in a proper avenue to generate an income. So this is what, the first step that they need to do when they are retired. Or even, they have done the need analysis or they have not done the need analysis. Going forward, this is what they need to do immediately. So once, yeah.
No, no, go. I was okay. So I was just going to kind of just summarize what you said so far. So before we step into to ensure what we need to do is put a table across. I started writing it down already. So put the needs on one side, which is housing, clothing, taxes, etc. Yeah, thank you for bringing up that slide. And on the other side, I like the part about travel that you said. I know some of us and our own parents are just avid travelers, and all their life they were running on the treadmill, and some of us like me are have been running on the treadmill of a job or a career, and never
Mhm.
got a chance to go around see the world outside of go and see the world for work or travel for work.
True.
So now we are exploring both domestic as well as international to figure out just our lovely own country as well as various places of history and interest on each people. But and travel expenses both become inflationary, and you touched upon health as well, that become inflationary. So yeah, I mean maybe I'll give it back to you to kind of understand that once we've done this need analysis, what's the next step that we manage
The
this?
next is, yeah, see, when we are talking about this, what do you call the gap analysis, then how are we going to get that money? So whatever the corpus that we have, one thing that we need to understand is the inflation. So the inflation, the purpose of investment, everybody is talking about how much return I would get out of the investments. They have to look at what is the real rate of return. So the real rate of return comes after adjusting the inflation. So inflation, yes, that keeps moving on and on every year. There is no stoppage of inflation. So this keeps moving every year. About 8% is the inflation. The government might be announcing the inflation at 4% or 5%, but still, I would say, the inflation, I divide this into two parts. One is actually the need-based expenses. The need-based expenses are food inflation, or maybe, your clothing and other things. These are the basic requirements. This will inflate at a certain ways. It'll inflate. But on the other side, look at the way how our lifestyle have changed. So in 2000, we were considering air conditioning is a luxury, and in 2000 nobody was having a mobile. Now nobody is without mobile, nobody was using internet. So these are the additional expenses without even knowingly we are keep adding up. So we may not know tomorrow, what is there on the cards. So might be, something else might come and replace the mobile, or something else might come and, now we are talking about, the going by flight and going by this one, even covering a small distance, people are targeting about five-seater aircraft, or five-seater helicopter, which travels for a shorter distance in a faster way. So that might be the, what you call the need of the hour. So that might change your finances. So the lifestyle expenses that will keep adding up, that will also add up with an inflation. And the food expense, food and other need-based expenses also on the other side, which will keep inflating. So when we are talking about 8% inflation, when we are investing in certain products, the main purpose of investing is to ensure that we get a better inflation adjusted return. If the returns provided by the instrument is less than the inflation, we are basically degrowing the money. That's the basic thing one has to understand. So the inflation and the taxes, these are the two things which we cannot avoid. That's number one. Number two is when we are talking about the inflation. Inflation is at the middle of the line, and there are products available above the inflation line, and there are products available below the inflation line. And it doesn't mean that we have to invest in all the products which are basically giving the returns which are above the inflation line. So there are basically, let us say, when we are talking about inflation, I don't know. So basically, when we are even I can give an example of masala dosa. We are all from Chennai, so everybody is across India. Everybody likes to have masala dosa. In masala dosa, when this was actually 40 years, 45 years back in 1980s, cost of a masala dosa might be Ashwin, you might be telling me what is the cost of a masala. You also might like masala dosa, right?
Of course, yeah.
So what is the cost of a masala dosa in 80s?
I would reckon something close to 2 or 3 rupees. Can't even.
2 3 rupees.
Yeah,
Now the same masala dosa, you can't get it anything less than 150 200 rupees.
yeah.
So dosa batter has not changed. The way how they prepare the dosa is not changed. Aloo is not changed. Only the price is changed. So rather actually instead of having a bigger dosa, the dosa size has become reduced. So that is what inflation is all about. Will eat up the corpus very quickly. So when we are talking about inflation again, option is people are scary about investments, but definitely without taking any risk, there is no product available. Even FD for that matter, if the bank goes bankrupt, so basically, they have only the insurance coverage of let's say about 5 lakhs for the per investor. So even that also carries risk. But having said that, each and every the product that we are talking about has a pros and cons. When we are talking about the 10-year GSEC, the interest rates keeps moving up and down. So the yield on G6, about few months back, it was at 5.5% or 6%. Now it is 7.2%. Even if it probably, after 1 year, if the RBI changes the interest rate, definitely there could be a risk on getting the returns out of your G6 or maybe on your fixed deposits. So basically, any debt instruments for that matter. One is the highest taxes. See, basically, when we are retired, we will all be under highest tax slab, one way or the other way. So when we are talking about taxes, when we are even getting 7% return, the net return that we are going to get only is about 4.5, 4.8%. That is what actually we are going to get in our hand. And on the other side, the inflation is at 8%. So we are degrowing the money without even knowing it by 3%. So it doesn't mean that you should not get away from fixed deposit. You need to have fixed deposit. So I'll explain what is asset allocation and strategic asset allocation in a different slide. But this is something one has to look at it. And secondly, the disadvantage with fixed deposits is basically this also carries a reinvestment risk. Assuming, 5 years back, when I deposited my money at a 10% interest rate or a 12% interest rate, now if I wanted to, if my deposit is matured, I wanted to invest back. I cannot have the same interest rate what I had 5 years back. So that is what we call it as reinvestment risk. So that is also there with fixed deposit. when it is coming to inflation, basically, the returns that are provided by the products which are above the inflation. One is actually gold. Gold is the safe haven. Gold as such, it's an investment avenue, but we don't recommend one to invest in the gold jewelry or ornaments. So the jewelry or ornaments basically, will be, I think somebody is unmuted.
No, we can hear you.
Yeah. So that is something, where we don't recommend the gold jewelry or ornament, because every time when we do the change of exchange of jewelries, we may be losing about 20%. Once you repeatedly do this for 5 times, the original cost is lost. So from that perspective, gold jewelry is not an investment avenue, but overall gold is an investment avenue. So why gold is an investment avenue? Because it is a hedge against inflation. And also, we are talking about inflation adjusted return. So this gives you exactly the inflation return. See, when the inflation is 7%, you get 7% return. When the inflation is 9%, you get 9% return on gold. That's the way it works. And also, when we are talking about gold, gold is the only universally acceptable commodity. So when you have 10 grams of gold in India, if you just go and give it to your shop, they give you Indian rupees. If you have 10 grams of gold and then carry away and then give it in Singapore, you get it in Singapore dollar. Or US, you get it in US dollar. So no other currencies, no other commodity is exchangeable to any currency. That is the key advantage of gold. And again, some of the clients or some of the retirees or maybe planning to settle down in other countries or wherever, they can have some kind of a gold as an investment avenue. And again, whenever there is uncertainty in the economy, the gold prices always tend to move up, because that is the easily exchangeable commodity. So that's the advantage of gold as an asset class. And it doesn't mean that all your money you have to put it in gold. So when we are talking about each and every asset class, it doesn't mean that one has to follow the entire money in one basket. So that's the way one has to look at things. And then when we are talking about equity, equity as an asset class, which basically depends on the economical development, it values keeps moving up, and it carries a risk also. See, in a short term, it carries a risk. There is a volatile market which the value might be going up and down. But if you look at from a 5 years, 7 years or 10 years perspective, equity is the only asset class which will provide you a better inflation adjusted return. So from that perspective, one has to invest all the asset classes, and one asset class which which is not mentioned here, I would like to explain about that as well. So one is actually the real estate. See, when we are talking about the in asset classes, the one is actually one is basically the real estate is one asset class, and then equity is another asset class, gold is another asset class, debt and debt related investments, fixed income is another asset class. These are the four asset classes available for any individual across, there could be different product titles. Maybe real estate is concerned, commercial or residential or, land or anything. So, but if you look at the major asset classes, these are the four asset classes that are available for any individual. So from that perspective, one has to have the allocation towards each and every asset classes. Of course, the real estate has its own difficulties in terms of illiquidity, and then it has maintenance problem, and then rental yields are low. These are the disadvantages associated with real estate. So, and also, we being a senior citizen, we will not be able to manage it properly. So being a senior citizen, real estate is something, they can avoid, and then basically they can have more into financial assets so that, it is more liquid in nature. Wherever they go, they can probably liquidate and then convert into other currencies. That's my viewpoint.
Thank you, Mr. Sridharan. So far, I think what we figuring out from you is that one is, of course, that have some kind of a strategic fund allocation or asset allocation to ensure that you have at least a sizable component of your assets parked in investments which are above inflation, or our returns are positive to inflation, and not negative to inflation. And your inflation, in your opinion, number that one should target is 8 as being a number to target. I think you're right in a way, because if one goes only by the four figure that the government or the Reserve Bank of India kind of targets, or publishes, that takes a much larger basket of food and electricity. But as you age, it's also about health, about travel. And I like the index of dosa that you use. We should have our own index, like the McDonald inflation index. We should have our own dosa index for in Mumbai. We use vada pav as a good inflation example. That when I was in college, what I used to pay for a vada pav and what I pay today is that
Exactly.
is summarizes what we are dealing with over here. So how do you kind of plan ahead, if based on the corpus that you've got across, is is there any format of asset allocation, or a simple format that, or a percentage to beat inflation? I think what you're suggesting is 60 to 70% of your assets should be, when you say majority, I'm assuming it's probably 60 plus a percentage of your portfolio should be in inflation beating assets. So anything above 8-9% should be the targeted investments. And I notice in your table that you've given gold, and you very nicely put that gold jewelry is not technically investments, because the making charges and the going in and out of it
Vestiges,
is, yeah,
yes.
it's more of an heirloom, or at an item for possession rather than item for investment. I think item for investment from a gold standpoint, while it's one of the good hedges against inflation, what you're suggesting is either go for direct physical uh, gold pieces
Coins.
or coins
Yeah.
that jewelers and banks kind of sell. But now with liquidity available even in gold bonds, which even the government is kind of offering retail investors small amounts,
True.
that's also an option. And I noticed in a table that the highest form of investments, which is beating inflation at close to about 13%, 12.93, or a 10-year period, is equity. But I'd like to ask you something, which is, equity is just equity, but for people like us who are not in the day-to-day active markets watching it, and the volatility, some of it can't, it gives me the heebie-jeebies many times, just looking at through navigating through volatility. What would be a surrogate way of looking at it? Is mutual fund safe enough? That's probably the best that we've all heard. Is it safe enough to look at? And one of the questions did come across is saying, are mutual funds safe? How would you analyze the part about this asset allocation? Where gold is safe, we know that. Fixed income is safe, we know that. And yes, they have varied levels of risk, so they are not safe as in 100% safe, but at least they are safe in terms of volatility, or other risk or market risk. But is equity or equity funds, or are mutual funds safe enough for a retiree? And how would you kind of allocate in that? Means what are safer and what are uh, uh, more volatile for, because your and my risk perception may be different as two individuals, and within the same age bracket, your and my risk profile would be different. So how does one think about
Yes.
that?
Yeah. So basically, as I told you, don't put all the eggs in one basket. So we need to basically do a kind of an asset allocation, spreading your investments across asset classes. So first is leave out your expenses for the next 3 to 5 years in the basically, it can be either in the form of bank fixed deposits or maybe in the liquid cash or whatever. 6 months you can just keep it in the savings account, and the rest of the money can be invested in the short term fixed deposit or something, so that is safe. Your next 3 to 5 years is safe. Okay. And the rest of the money, maybe you can have an asset allocation of, let's say, about when we are talking about equity. So we don't recommend direct equities for the retirees. Basically, it carries a lot of risk. One, in terms of identifying. Second, in terms of actioning at an appropriate time. And thirdly, you need to always be watching the market, which is very impossible for senior citizens. And again, they are all. This is the last earned money that they have. So they don't, the risk appetite might not be so heavy so that they can accept the losses. So from that perspective, instead of investing in direct equity, they can go for a managed portfolio. So the managed portfolio is in the form of PMS or in the form of equity-based mutual funds. So equity-based mutual fund is a very well professionally managed, and there are a lot of there are about 40 AMCs available. They can pick up whichever they are comfortable with. So they can choose the funds which are predominantly large cap oriented funds, and to some extent they can add up some mid cap, not into small cap. Small cap is something that they can avoid. Though it might be providing you a superior return, but the risk associated with it is very, very high. So they can get a stable return from a large cap that might be 10-12% return they can easily get on a large cap funds. So idea is, when the inflation is 8%, if I am getting, let us say, about 2-3% higher than the inflation, I am happy after adjusting tax, because the equity mutual funds, one has to pay only 10% tax. So it is not like your fixed deposits or other fixed income where they need to pay 30% tax on the if they are on the higher tax level. So from that perspective, they can have setting aside 3 years of working capital, or maybe their expenses. The rest of the money, if they have 100 rupees, they can have about 10% allocation towards gold. Gold is something, which may not be delivering good returns in the short period, but over a long period, it could deliver a good return. So they can have about 10% allocation towards gold, and then they can have about, let's say, about 40% allocation towards equity based mutual funds. If their corpus is high, they can have 10% allocation towards maybe PMS or something, which is a little high risk, but still the returns will be bit better. So this 50 plus 10, 60%, another 40% allocation they can have it in debt instruments. That might be a 3 year or a 5 year debt based investments in a well corporate bonds, or the 10-year GSEC that they can just buy and lock it. This is something 50% towards equity, and 10% towards gold, and 40% towards debt, after setting aside 3 years of expenses. So this is something that I would recommend for a senior citizens.
No, interesting. You say that, keep aside about for 3 year expenses and the rest investable corpus, so to say, or rest of the savings, to generate an alpha, generate a return, split it across equity-based funds, gold, uh, debt instruments, and the 10% PMS, depending on the size of your corpus, can be either 10% PMS or go back to equity based funds, because PMS requires probably larger chunks. Minimum, I
Exactly.
think, minimum, if I'm not wrong, SEBI is prescribed, I think, minimum 50 lakhs as
50
in,
lakhs is the ticket size for a
yeah.
PMS.
So if anything, 50 lakh in a PMS. So One is only if he has any somebody has higher can that be added? Otherwise, go back to
Yeah.
looking at equity-based mutual funds.
This is
Questions are
again,
sorry. Yeah.
this is again for the risk profile where they are ready to take high risk, aggressive.
I like that what you said, and there's a question already which was posed on our funds. What's our funds safe? So I think you've kind of have alluded to they are since they are diversified and they are fund houses with good track record. They are safe enough to be able to take uh, reasonable risk, because you also alluded to the fact that banks are also technical riskier. Banks can go bankrupt, and we all have in the last 20 years we all have faced both globally as well as locally.
Yeah,
So interesting. One on the side, I think, since we are already into the time and questions are also coming in. Let me take one which has just come in a little while back, is which is saying that index funds. Since you alluded towards funds, index funds. What are the pros and cons of an index fund? And soon after that, you can take up the question of or take up a comment about what exactly is a PMS. So I think if you could just allude on both of them one after the other.
yeah. So basically, when we are talking about mutual funds, there are two things. One is actually actively managed mutual funds. The actively managed mutual funds are managed by a fund manager. So they always, keep looking at the trends of the market, and based on that, they keep, investing in those sectors and stocks to produce higher alpha. On the other side, index funds are basically, these are all exchange traded funds. There is the benchmark which is being created. It just reflects the benchmark. Assuming, Nifty 50 index funds, it just invest in Nifty 50 benchmark index, whatever the allocation is there, they just mirror image the index so that its performance is equivalent to the index performance. There is no alpha that can be generated out of index funds. So that is the difference between actively managed and passively managed, which is called index funds. The key, advantage of index fund is lower cost, because there is no fund manager expertise or fund manager experience is required. So that way, actually, the cost effective way of investing is through index funds. But in India, of course, in the recent past, only large cap funds are basically, have outperformed the large cap. I mean to say, the large cap index funds, the Nifty 50 or the Sensex 30, this only has basically outperformed the large cap funds. But over a long period of time, always the actively managed funds will be providing you a better return, because we pay money for a person who work for us. That's the difference, basically.
The PMS question, what's a PMS and are fees on PMS deducted from taxable income?
Okay, so PMS is basically portfolio management services, which are basically different from mutual funds. See, when we are talking about mutual funds, in a mutual funds, there are about 100 stocks that will be there. Whereas in the PMS, it is a very concentrated portfolio, which might be having about maximum of 15 to 20 stocks or 25 stocks. That is the stocks portfolio. It carries a concentration risk. And secondly, the filtration itself is different for PMS, because the minimum ticket size is 50 lakhs. So here actually, the kind of concentration that they have, it gives you a higher alpha, and there is no immediate liquidity that could probably pose problem to the PMS. Wherein in the mutual funds, it is basically being targeted towards the retail segment. If there is something wrong, people might be withdrawing without even knowing the reason. Whereas in the PMS, it is very, very concentratedly managed, and very well informed investors only will be investing in PMS. So from that perspective, a well concentrated, well managed portfolio is being done in the PMS, unlike your mutual funds. This provides a higher alpha also.
So effectively, it's targeted towards more experienced and knowledgeable investors.
Investors.
It is
Yes,
liquidity is not available like a mutual fund. There's no open and there's no redemption and investment
correct.
daily
Eh,
basis. And and unlike a mutual fund, which is retail, you can invest as less as 500 or 1,000 rupees. Here,
Correct.
minimum ticket size is 50 lakhs and in a closed format, which is there. And
Yeah,
therefore, the concentration of lesser number of stocks that the portfolio manager manages over here, which is close to anything. I think I've seen something which is as less as even 15 stocks, not more than that.
exactly. True.
Whereas a mutual fund is very well diversified. Again, therefore, the returns are higher because concentrated risk returns and possibly potentially even losses. So it's
Yes.
it's not always a return. So
On a 5-year basis, it
yeah.
could provide a better return, not on a 1, 2, 3 years basis.
Correct. It has a far more potential of swinging either
Yes.
side because it's concentrated. So one needs to know about that, and therefore it's targeted to more knowledgeable investors. A question
True.
which was here was more about tax deductibility. I'm not sure you want to take that up as or do you advise on tax? Are fees on PMS deducted from taxable income?
No. See, basically, the this is any management fees that
Yeah,
will be deducted on the investment value that you have made with the funds, and that is actually is considered as an expenses. It will not even come into your balance sheet
yeah.
or coming to your tax statement.
Tax statement. Yeah, yeah. A question from Bina is talking about is if in a PMS if one needs to take money out if a need for money arises, what is the procedure? If I maybe you're the better judge over here, but I think there are certain break costs etc. involved. It's each
Exactly.
there is no regulatory cap either ways of how much breakage can be charged. Each portfolio manager has different schemes for early withdrawal. But you're more experienced. Any comment on that?
Yeah, exactly. What you said is right. See, basically, they have the exit loads. There is no lock-in. Literally, there is no lock-in in any of the portfolio in PMS. Okay, so what they have made is, there is a breaking charges that will be levied when when they have set up a breaking fee of, 1 year or 2 year. Within that, if somebody breaks, they have to pay the penalty. That's the only clause that is available. Other than that, it is highly liquid in nature. But only the thing is, you'll have to depend on the market value only you will be getting it. So assuming you're investing with the time horizon of 5 years, 1 year later you wanted to withdraw, the market is good, you could have good value of whatever the investments that you have. The market is bad, you will get whatever the value that you have at that point in time.
One rightly, while more questions come in, and I kind of I think one of the things in an earlier session on strategies which we spoke about, and a little personal belief of mine also is that if you're going to invest in equity or any equity, not equity is the name for I'm using for across anything equity related, the minimum horizon you should mentally keep for, and I think you've given a nice way of saying is that whatever you need for the next 3 years, keep that aside for expenses, and anything else you do an asset allocation. So I would agree to that. I would say that the component which goes to allocates to an asset class like equity should have a horizon mentally in your hand in your head for about at least 5 years. And unless there's some major emergency and you've parked and even that parked amount from equity is needed, that's very unfortunate. But I think in a withdrawal strategy, when you need to kind of take out in an emergency, equity should be the last one to be broken unless it's completed 5 7 years and you've got your targeted return of 13 odd percent.
So my take on equity investing is basically we have 3 years of working capital. And secondly, we have 40% available in any kind of debt funds which can be liquidated at any point in time. So what we are risking out is only 50% of the money. The other 40% of the money is in 50% of the money that is in what do you call equity. So from that perspective, one need to have minimum of 3 years up is what actually I would always look at investing when somebody is interested in investing in equity based mutual funds. So they should have minimum of 3 years to 5 years. That's something that they need to hold on. Anything above 5 years, they need not have to really worry about investing in equity based mutual funds. They can pretty much invest in equity based mutual funds if they are little vary of risking. Then probably they can look at hybrid kind of funds. There are variety of funds that are available based on the investors risk ability, risk taking ability. So based on that, one can invest, one can probably risk out investing in the equity based mutual funds. But having said that, anything less than 3 years, one should not even look at equity based product, irrespective of wherever the market is heading. We may be saying plenty of talks about next the election is going to be the BJP might be winning, and based on that financial market might be boosting. All these things are only on the top, but when it comes to individual, reality is something different. So we cannot blame Modi tomorrow. So if he is not actually if he is not elected. So having said that, minimum of 3 years of time horizon with which actually one should even venture into investing in mutual funds, equity based mutual funds.
Yeah, interesting. And one question which has just come up is an interesting one. How frequently should individuals reassess and adjust their retirement strategy in response to market conditions? Is there How frequently how do you do for your client?
Very, yeah, very, very nice, important question, which I missed it basically. It is not that, it is not something, fill it, forget it. We have to, recheck whether there is an engine oil or not. So basically, my recommendation to the senior citizens is basically once we set up the whole thing, assuming you have identified your needs and then you have identified your products and then you have basically invested in those products as well. It does not stop there. So one has to do the reassessment and reassessment of the needs on a yearly basis. And secondly, the portfolio review has to be done on a half yearly basis. Every half yearly basis, they need to recheck on where I started, where we are right now. Is there any changes that are required? It doesn't mean that every day we need to look at the market, but you need to look at whether my portfolio is in line with the target what we were discussed earlier. So that is something which is very, very important.
Nice. So annual review and a 6 monthly check on the portfolio.
Yes,
So when you say
that's enough.
review, okay, 6 month review. So how you review your entire asset allocation every year?
Review your entire asset allocation every year. Review whatever the investments that we have made on a half yearly basis.
Okay, okay. I think okay, I get it what you're saying. So a related one is and a little more subjective, and you again is are there strategies to stay disciplined and avoid making impulsive financial decisions during turbulent market periods?
They need to be very well disciplined. So discipline is something. See, basically, everybody is looking at what is the return I get. That is what they look at it. So in the wealth creation formula, you know, there's something called the time that you need to give for the portfolio. The T is very important in the compounding interest. So the T is what actually many people behaves erratically when the market is down. When the market is up, also they behave erratically. See how they lose money is the impulsive decision. They have money. They will wait for the market to correct. But the market may never correct, and it keeps moving up and up and up. So when the market is at its peak, they may think that no, this is the time to invest. How long I can wait? They will invest at the peak of the market. Then after the investment, the market will keep falling down. Then what they do is, when it falls to the bottom, that time they pull out. Again, this activity they keep repeatedly doing it, so they don't make money. So they basically, have a discipline and give the time to the fund manager to manage the portfolio over a long period. The fund of the fund manager is to stay invested long time and make your investment work for you. That's something which is very very crucial in terms of taking right investment decisions. It is not only right investment decisions, discipline is very important.
I like it what you said. Discipline is important. And another session which we were having about behavioral finance some weeks back is and it's alluding to the similar point. What you're saying is that it's not timing the market, but time in the market.
Yes,
Especially when you have to generate that alpha of beyond inflation, which is close to your 13% target, which is the 8% being inflation, and we've seen that it has historically always given about close to 13% if you stay long enough, 10 years in the market. So I think staying disciplined is good. And a format which a lot of people follow is smaller amounts at dips. So like the SIP format, whether in a disciplined SIP format or and a parallel, they from the debt side they use a systematic withdrawal strategies to execute. So
correct.
uh, those are also examples. A question around the senior citizen savings scheme.
That's one such scheme one can pretty much invest. So maximum of 30 lakhs limitation is there. So senior citizens can pretty much enjoy investing in senior citizen savings schemes, no doubt about it. But the maximum investment one can invest in a senior citizen savings scheme is 30 lakhs,
Yeah, so you
and there
would
is a lock-in period of 5 years.
yeah you would bucket that in the fixed income asset allocation
Fixed income,
table
yes,
that you mentioned
yes,
earlier. Yeah.
yes, yes.
So that component goes over there. Should one be going through one company for sound portfolio? I think the question over here from Mini is largely about should only one planner do your entire portfolio management? Is that I think that's what Mini is probably asking. Uh,
Obviously, see, one planner is more than sufficient. Instead of giving it to two or three different people, and everybody gives different perspective on investments. Rather, before giving it to one person, evaluate and then do the due diligence and then give it to the person. So you have to understand from different perspective. See, basically, when we are not well, we go to a multi-specialty hospital or a local hospital where they have only limited resources. So that is something that they need to look at it and then give it to them fully so that they understand you better, and they will see if at all if something is needed. For example, being an investment advisor, if the client wanted to create a will, though the investment advisor is not a lawyer who can help you out creating a will, but they can arrange a lawyer with whom you can have a discussion and then we can create a will. So that's something which is pretty much possible. So these are all the things that they need to look at it, and based on that, actually, they need to choose the investment advisor. So it doesn't mean that they need to know everything, but whether they have the capability to organize and give what the client wants.
Thank you. And I think when you there's a related question is more about Danny is asking a question is that what are the tools or websites or reading material that one can refer to understand the various investment strategies or parameters or where could just basically is there a learning avenue?
Templeton Academy is there.
Thank you very much. Yes, Franklin Templeton has enough of on their website, lots of learning material there, and you can access a lot of independent for senior specific and because Get Set Up is has a resource for which is very very curated by our own community seniors and finance professionals again who've been professional in the business just like Mr. Sridharan. So you can access it on our Get Set Up portal or Get Set Up group of Facebook. Join us, and you could get a lot of content over there for across financial planning and many other such similar topics of interest. I think I have maybe one more last question from my end, if there is none on the chat box, something which came earlier is we've addressed the part so far about uh, keeping needs and keeping what I have, then doing a strategic allocation across various asset classes to ensure that we take care of inflation on one side, and other uh, interests of ours, including travel and luxury, but more importantly, again, keeping some amount of exigencies for healthcare required. So do an asset allocation. Do an asset allocation evaluation, or do your portfolio evaluation at least once a year. And most importantly, uh, have some component in asset classes which give you more than 8%. And I think 8% is a thumb rule you're using, but anything which beats inflation. So keep a watch even on inflation numbers in general to be able to counter all of that. Is there any strategy or any thoughts that one needs to uh, take care of in these investments? In terms of an ideal asset allocation. I don't know, is there an ideal, because each individual and risk parameter is different, but there's a question about, is there an ideal allocation? I think you partly addressed that in a way with saying that 40% equity, 10% gold, debt instruments 40%, and the last 10% across, again, more equity focused, which is PMS, or goes back to any of these out of choice. So can that be a formula to live with?
That's the formula for an aggressive investor. And if there are moderate or a conservative investor, they can reduce the equity exposure and keep more on fixed income.
Yeah, I think what your formula is, or your thumb rule is more to ensure that it counters inflation. Uh,
Hmm.
so depending on each one's level of expectation of inflation and risk profile, a combination of two, you would allocate between, say, fixed income, debt, or other assets. I think if we come to the end of the session, one last question Minnie is asked, any comment around the gold monetization scheme?
Gold monetization scheme, yeah, see, one can use the gold monetization scheme that is yet to become popular because it is being announced and some of the banks are not offering, some banks are offering. So they need to go check and then have to do the gold monetization scheme. So that depends on the individual banks basically.
Got it, sir. I think we have no further questions, and if there are any which come across, please do reach out to Get Set Up. Our colleagues will be more than happy to direct the answers back to you. Join our Facebook communities, join our WhatsApp communities, and join us as a community for older adults by older adults. Mr. Sridharan, thank you very much for your time.
Yeah,
Uh,
thank you.
Very informative session. Some comments have come already. People are appreciating the fact that you yourself have managed your clients through the retirement phase and allocating asset allocating. If anybody has any specific question for Mr. Sridharan, just reach out to us, and we'll have him answer it separately and send it across to you all. Uh, with that, watch out for other such similar sessions on financial well-being, on health and wellness, on other topics of interest for our community and by our community. So thank you very much, sir. Thank you,
Thank
everyone.
you. Thank you. Welcome. Yeah.
Bye.
Yeah.